Welcome! In this video, we'll reveal why temporary low-income years are not setbacks, but urgent tax opportunities. We'll show you how to capture the 0% long-term capital gains bracket and how to execute strategic Roth conversions while your tax rate is unusually low. We'll also model how to stay within target brackets, outline deadlines you must hit by year-end, and share key cautions.
Now, let's set the stage and preview our agenda.
Here's the roadmap. First, we'll explain why low-income years create outsized tax opportunities. Next, we'll cover the 0% capital gains harvest. Then, we'll walk through the aggressive Roth conversion. After that, we'll model your income and share a practical year-end checklist. We'll close with key pitfalls and a quick recap, plus 2 short quizzes to lock in your learning. Let's begin with the core idea. Temporary income dips from school, a career change, or unemployment can feel discouraging. However, these periods can be powerful tax planning windows. With your taxable income lower than usual, select strategies become available that are either impossible or far less efficient in high-earning years. Specifically, you could harvest long-term capital gains at a 0% tax rate and convert pre-tax retirement assets to Roth at low marginal brackets. With that context, let's dive into the first strategy. This strategy is called 0% capital gains harvesting. The idea is to realize long-term capital gains while your taxable income is low enough to fall within the 0% long-term capital gains brackets. First, estimate your taxable income after deductions and compare it to the current year IRS threshold for your filing status. If you're below it, you can sell appreciated investments that you've held for more than 1 year, realize the gains at a 0 tax rate, and immediately repurchase the same assets. Wash sale rules do not apply to gains, only to losses, so the immediate repurchase is allowed. The effect is a step up in your cost basis, which reduces or even eliminates taxes when you eventually sell in a higher income year. Always model your full income picture to avoid pushing yourself out of the 0% bracket. Also consider state taxes, which may still apply. Now that you understand gain harvesting, let's test your knowledge. Quiz time. The question is, do federal wash sale rules prohibit immediately repurchasing a stock after harvesting long-term capital gains at 0%? Option A, yes, you must wait at least 30 days. Option B, no, wash sale rules apply to losses, not gains.
Option C, only if your gains exceed a certain dollar amount.
Option D, it depends on the brokerage.
You may pause the video now to think about the answer. We will discuss the correct answer in the next section of the video.
The correct answer is no. Wash sale rules apply to losses, not gains. Wash sale restrictions are designed to prevent the artificial creation of deductible losses, not to limit realizing gains. Therefore, after harvesting long-term gains, you can immediately repurchase the same security under current rules. Next, let's move to the second major strategy, the aggressive Roth conversion. A Roth conversion moves money from a pre-tax retirement account, like a traditional IRA or 401k, into a Roth IRA. You pay ordinary income tax on the converted amount in the year of conversion. The advantage during a low-income year is that your marginal tax rate could be much lower than usual, allowing you to pay a smaller tax cost now rather than at potentially higher rates later. Future qualified withdrawals from the Roth are tax-free, and there are no required minimum distributions for the original account owner. However, be careful. Conversions increase your income for the year, which can affect health insurance subsidies, education credits, or other benefits. Use partial conversions to fill up a target bracket without crossing into the next one. With that in mind, let's compare converting now versus doing nothing this year. On the left, converting now lets you intentionally recognize income while your marginal rate is low, exchanging today's small tax for lifelong tax-free growth and withdrawals. It can also reduce future required minimum distributions.
The trade-offs are the immediate tax bill and possible interactions with credits or subsidies. On the right, doing nothing defers the decision but risks paying at higher rates later and could increase future required distributions. The optimal choice often involves a partial conversion sized to fill the top of your current target bracket without spilling into the next. Next, let's learn how to model your bracket and track all the moving parts. To model your bracket, start by projecting all income sources: wages, side income, unemployment compensation, interest, dividends, and realized capital gains. Then, add your proposed Roth conversion amount. Subtract above-the-line adjustments and your standard or itemized deductions. Confirm your filing status.
which determines your bracket thresholds. Estimate both federal and state taxes, and consider how your income level interacts with credits and benefits, such as health insurance subsidies or education credits. Use reliable tax planning software or a robust spreadsheet to iterate scenarios. Maintain a safety buffer below your target bracket tops to reduce the risk of spilling into the next bracket due to unexpected income, dividends, or fund distributions. Now, let's translate planning into deadlines and action steps. Here is a practical checklist. First, estimate your full-year taxable income as early as possible using pay stubs and brokerage reports. Next, harvest eligible long-term capital gains before December 31st, mindful of ex-dividend dates and fund distributions. Execute any Roth conversions by year-end as well. These are calendar year dependent. Rebalance after harvesting as needed, and update your projection after each transaction to ensure you remain within your target brackets. Finally, document basis step-ups for your records.
With deadlines set, let's visualize the overall timeline.
This timeline begins with estimating taxable income and setting target bracket ceilings. In early December, you harvest a portion of long-term gains and check remaining room. By mid-December, you execute a partial Roth conversion sized to fill most of the remaining bracket. In late December, you perform a final top-off harvest or conversion if there is still room. December 31st is the hard deadline for both gain harvesting and Roth conversions. In early January, you reconcile your records and gather tax documents. Now, let's reinforce these concepts with another quick quiz.
Here's the second quiz. You are within a low bracket and want to implement both a 0% gain harvest and a Roth conversion. Which sequencing best helps control bracket creep? Option A. Do the full Roth conversion first, then harvest gains. Option B. Harvest some gains, check remaining room, then do a partial Roth conversion. Option C. Do both at once without modeling because they cancel out. Option D. Only harvest losses to avoid taxes. You may pause the video now to think about your answer. We will discuss the correct answer in the next section.
The correct answer is to harvest some gains, check the remaining room, and then do a partial Roth conversion. This sequencing allows you to measure the bracket impact of realized gains before sizing the conversion to fill, but not exceed, your target bracket. Now, before we wrap up, let's cover an important disclaimer and key cautions. This content is educational and not individualized tax, legal, or investment advice. IRS, thresholds, forms, and rules change. Verify the current year numbers before acting. State taxes may differ and can reduce or eliminate the benefit of federal strategies. Consider potential interactions with the alternative minimum tax, health insurance subsidies, education credits, and Medicare premium surcharges. Always confirm your holding periods to ensure gains are long-term, and document your basis and transactions. When in doubt, consult a qualified tax professional. With cautions covered, let's summarize the key takeaways.
Remember these points. Low-income years create rare windows for lifetime tax savings. 0% long-term capital gain harvesting steps up basis and can eliminate future taxes when you sell later. Roth conversions performed in low brackets can outperform waiting until higher income years. Model your whole year, leave a buffer below bracket thresholds, and hit the year-end deadlines. Finally, coordinate with credits, benefits, and state taxes to avoid unwanted side effects. Now let's wrap up with a quick summary.
In summary, if your taxable income is unusually low this year, you can realize long-term gains at a zero tax rate and immediately repurchase to step up your basis. Use partial Roth conversions to intentionally fill, but not exceed, your target bracket. Update your projection after each action to avoid creeping into higher brackets. These strategies require execution by December 31st, so plan and act ahead.
Finally, here's a quick thank you and a call to action. Thanks for watching. If you found value here, please like the video, share it with a friend who's in a low-income year, and subscribe for more actionable tax planning strategies. Drop your questions or your planning scenario in the comments. What bracket are you aiming to fill, and which move will you tackle first? See you in the next video.